I keep hearing the same thing. AI stocks are overpriced. And yet, money keeps pouring in. Welcome to the AI paradox, when everyone sees a bubble, but buys anyway. In a Motley Fool survey of 2,600 investors, 93% said they'll maintain or add to AI positions next year. 41% believe we're in a bubble. Investopedia, 2 out of 3 investors say AI stocks are overvalued. So what's going on? Part of it is FOMO versus fundamentals. Valuations look stretched. The S&P 500's cyclically adjusted PE CAPE hit 39.42 in December 2025. That's within reach of the dot-com peak at 44.86. On the other hand, the growth story feels undeniable. Miss it, and you risk missing the next decade's compounding. Goldman Sachs says today looks a lot like 1997. 5 warning signs are flickering. Peak investment spending, falling corporate profits, rising corporate debt, Fed rate cuts, widening credit spreads. Investment spending is the loudest signal. Amazon, Meta, Microsoft, Alphabet, Apple are projected to spend about $349 billion on AI infrastructure in 2025. That echoes the late 90s when tech investment surged to 15% of GDP before things cracked. But here's the twist. The real bubble may be in private markets, not public stocks. Look at Nvidia. The share price is up roughly 12x in 3 years, and earnings rose by about the same multiple. That's not classic bubble behavior. Meanwhile, the Magnificent Seven aren't moving as one. Alphabet leads with around 63% gains through late December. Nvidia's up roughly 30 to 41%. Tesla, Microsoft, Apple, Meta, Amazon, many trailed the S&P 500's roughly 16% this year. As the Motley Fool's Asit Sharma put it, if all of the AI momentum suddenly came to a stop in their businesses, they wouldn't go anywhere. These companies still have powerful, diversified revenue streams. Here's the risk: concentration. The Magnificent Seven now make up 34.3% of the S&P 500, up from 12.3% in 2015. When that much of the market rides on a few names, shocks hit harder. Analysts estimate the industry may need $2 trillion in annual revenue by 2030, more than the combined projected 2024 revenue of the 5 largest tech companies. That's a high bar. So why do investors keep buying? Simple: asymmetric risk perception. Miss the next platform shift and you underperform for years. Own the leaders, and even if AI cools, the businesses still throw off cash. Investors are hedging regret as much as they're chasing returns. My playbook? Separate story from price. Track cash flows, CapEx discipline, real AI-driven revenue, not just press releases. Diversify beyond the headliners. And remember, FOMO fades, fundamentals compound. Choose accordingly. Markets move fast, but informed investors move faster. Thanks for watching. For clarity before the chaos, please like this video and subscribe. Let's talk trade.